PepsiCo trades at approximately $140 per share for a market value of $191 billion. At that price, our reverse DCF implies approximately 2.2% annual unlevered free cash flow growth for the next 10 years. That price-implied path takes estimated unlevered free cash flow from $10 billion today to $13 billion in year 10, 1.2 times the current level. Over fiscal 2022 to 2025, reported free cash flow grew by 11% per year. That is the delivered record beside the price-implied 2.2% annual growth path. Is this a reasonable price, or does it leave too little room for error? To answer that, we run the valuation through three lenses. A reverse DCF reveals what the current price already assumes. A traditional DCF estimates what the business could be worth under bear, base, and bull scenarios. And a price-to-earnings multiple adds context from comparable historical and market anchors when those are available. Three lenses, one conditional verdict. We model PepsiCo's cash engine as volume to price mixed to brand margin to free cash flow. The template's proposed defense is decades of consumer habit and distribution. Shelf space and loyalty are rebuilt slowly, if ever. For an upside case to hold, four things must be supported: volume resilience, pricing power, cost discipline, and return on capital. We will test each one later. Before the valuation, the track record. What has PepsiCo actually delivered? Over the last 3 years, revenue grew approximately 2.8% a year, earnings per share declined approximately 2.2% a year, and reported free cash flow grew approximately 11% a year. Reported free cash flow margin moved from 6.5% in fiscal 2022 to approximately 9.6% for the latest trailing period. In the quarter ending June 2026, revenue grew 6.4% year over year, broadly in line with its recent trend. The question is whether that continues. PepsiCo earns more on its capital than that capital costs, but not by a wide margin. Our accounting estimate puts the return at roughly 16% against 6.9%. You can see it on the chart. The stock has lagged the broader market over this period. That relative weakness is useful context for the valuation. But recent growth is the starting point of this analysis, not the forecast. The question is never what was delivered, it is what the price now requires. At the time of this analysis, PepsiCo trades at approximately $140 per share for an equity value of roughly $191 billion. Estimated trailing unlevered free cash flow is approximately $10 billion. A traditional DCF starts with forecasts and calculates a value. A reverse DCF does the opposite. It takes today's value and solves for the growth rate that makes the price possible. We use a discount rate of 6.9%, the company's estimated cost of capital, terminal growth of 2.5%, and the company's estimated unlevered free cash flow base. One adjustment first. PepsiCo carries net debt of about $42 billion, so we solve against enterprise value rather than the headline market cap. The result, on these assumptions, today's price implies approximately 2.2% annual unlevered free cash flow growth over the next 10 years. The market's math under our assumptions, not a fact. And the direction is sensitive. Across reasonable discount rate and terminal growth assumptions, the implied range spans decline to growth. That growth path takes unlevered free cash flow from $10 billion today to approximately $13 billion in year 10, 1.2 times the current level. Watch it compound. Year 1 already needs roughly $10 billion. By year 5, approximately $11 billion. Each year building on the last, with no year off. That target has operational consequences. Holding the current estimated unlevered free cash flow margin at 8.3%, PepsiCo would need approximately $154 billion in annual revenue by year 10. The market is not pricing in one more strong year. It is pricing in 10 years of sustained delivery. But does our own forecast produce the same value? Now I forecast the business itself. $97 billion of trailing revenue, and how much of it turns into unlevered free cash flow. The base path starts at 2.9% and recovers only to 3%. That is trailing revenue growth blended with forward analyst consensus. Cash conversion drifts down slightly, from 10.5% of revenue today to 8.3%. With a 6.9% discount rate and 2.5% terminal growth, that produces $117 per share. That discount rate is a market value WACC built from a 4.7% risk-free rate, beta of 0.8, 4.5% equity risk premium, and 2.1% pre-tax debt cost. About 63.4% of modeled enterprise value comes from the terminal value, so the result remains sensitive to long-run assumptions. The bear case starts at 2.5% growth and assumes cash conversion never improves at all, holding at 8%. It is worth $108. The bull case starts at 3.3% and reaches 13%, the best margin its industry achieves at scale. It reaches $189. The width of that range is not our opinion. It is the spread between the highest and lowest analyst revenue estimate, and here they are unusually close together. At $140, the stock sits above our base case, inside bull territory. The DCF gives us a value. The multiple tells us what investors are paying for it right now. Our final lens is the valuation multiple. PepsiCo trades at approximately 18 times trailing earnings. Based on expected forward earnings, that falls to approximately 16 times. The gap reflects the growth analysts already expect. The company's own median across 4 fiscal observations is approximately 24 times. The broader market trades at approximately 24 times on a configured trailing price-to-earnings benchmark. But the lenses disagree here, and that matters more than either one alone. On forward earnings, the multiple looks reasonable. Measured against the free cash flow PepsiCo produces today, our model says the price still demands extraordinary long-term growth. A fair multiple on forecast earnings is not the same as a fair price for the cash. The valuation survives mathematically, but only if a few conditions keep holding. Now the evidence. Volume resilience is mixed. Revenue grew 6.4%, but the data does not isolate volume resilience. Pricing power is mixed. Revenue growth of 6.4% and reported free cash flow margin of 9.6% do not isolate pricing. Cost discipline is mixed. Reported free cash flow margin is 9.6%, 3.1 points above the oldest year. Return on capital is supported. Return on capital of roughly 16% against a 6.9% cost of capital. 1 of 4 is supported. Volume resilience, pricing power, cost discipline remain unresolved. The verdict remains conditional. Now stress the model. The business risks are volume stagnation, trade down pressure, brand reinvestment. The screen translates them into exact valuation inputs. First, cut starting revenue growth to 70% of the base assumption. Fair value falls to $111. Second, reduce the steady-state free cash flow margin by 20%. Fair value becomes $93. Third, raise the discount rate from 6.9% to 7.9%. Fair value becomes $90. Finally, combine all three while fading mature growth to the terminal rate. The model falls to $66. These are standardized model stresses, not predictions. They show which assumptions the valuation is most exposed to. These risks do not need to destroy the business. They only need to produce results below what the current price already requires. The standardized stresses show how the valuation moves. But before the verdict, there's one counter-argument this analysis owes you. One more test before the verdict, and one important counter-argument to answer first. On a normalized historical return of roughly 16%, PepsiCo earns 9.3 percentage points more on its capital than that capital costs. Sustainable growth is roughly return on capital times the share of profit reinvested. Holding that share steady, the growth this price requires would require reinvesting roughly 14% of after-tax operating profit. So capital may not be the binding constraint. The harder question is whether it can be deployed at similar returns while revenue scales to the level this price implies. 2 caveats. That identity describes operating profit, not free cash flow, so it holds only while the reinvestment rate is steady, and a past accounting return is no promise about the next investment. That is the last piece of evidence. So what do all 3 lenses say together? 3 lenses. Here's the verdict. Lens 1, the reverse DCF. The price demands 2.2% growth every year for 10 years, a lower implied free cash flow path than the company's recent delivery, but not a guaranteed outcome. Lens 2, our own DCF, $108 in the bear case, $117 in the base case, $189 in the bull case, and the current price sits above our base case, inside bull territory. Lens 3, the multiple, a multiple in line with its own median across 4 fiscal observations. The combined downside case lands at $66, approximately 52.5% below the current price. Add the 3 together and the verdict is demanding, but not irrational. The price sits between our base and bull cases. The market is paying for execution above our central case. On these assumptions, the model shows limited room below the price before the base case thesis weakens. Our overall verdict: priced for strong execution. Business quality and investment value are different questions. This conclusion remains conditional on the evidence and assumptions shown. That is the analysis. Thank you for watching. This analysis is a valuation framework, not financial advice. The result depends on the assumptions shown, and you should always verify them and do your own research. Snapshot, August 2nd, 2026. Position, not disclosed. The description lists sources, method, and AI use.